So if we ignore the boring topic sentence there, or the topic detail name of this presentation, this is one of those ones where I think the government has got it right. What they've done is said, look, for small businesses, particularly when you start out, you might not have had the right structure. It might not suit if you've grown, if you've changed, if you've moved on in any way. So what the government did with these new provisions is effectively say, look, if you started out, what it's aimed at really is, if you started out as a sole trader, if you started out in a family partnership and your business is growing, and you think you'd like some asset protection, you'd like to move into a bit more of a corporate type environment or a trust environment, we're going to allow you to move from your current structure to a brand new structure which suits those sorts of purposes without having to pay any income tax. So that's quite nice of the government, because usually it's we only had limited ways of doing it prior to this. So how the rollover, or how it works, is you're given a rollover. So effectively any income tax consequences are ignored. For pre-CGT assets, those are the assets that were acquired before September 1985. That status is maintained when you go from your sole trader family partnership through to a corporate structure or a trust, or whatever structure you so choose in the circumstances. For CGT assets, you are deemed to acquire them at the relevant cost base. Things to be aware of are that, at least currently on the reading of the legislation, the transfer costs don't appear to get included in the transferee's cost base. It seems like it's a bit of an oversight and it's sort of hanging out for some ATO commentary, but that's the first issue. The other one is, if you do acquire a CGT asset, your access to the general discount, the general 50% discount, you need to wait another 12 months from the date of acquisition before you can claim that, if you do dispose of anything in that period. Luckily enough, there is a deeming provision which says for the 15-year small business concessions, we're going to maintain that 15-year ownership period, which is quite nice. For trading stock assets, effectively you get to acquire them at costs, or if you've held them at 30 during the previous year, whatever valuation method you adopted for them. For revenue assets, you get to acquire the cost, which would result in you not making a profit or a loss, and for depreciating assets, the written down value. Just again, a couple of quick criteria, the qualifying criteria, and then we'll get into hopefully some useful examples once we've also run through some of the other tax issues. So it needs to be a genuine restructure. By that, you need to have more than just tax drivers. Tax can be a driver, but you need things like asset protection, business efficacy. You might want to set something up for a future acquisition date in a particular structure which it doesn't suit your current structure. And also needs to be an ongoing business. So yeah, an enterprise, as you'd imagine. You have to be a small business entity, or a connected entity or an affiliate of a small business entity. Then the next issue, which sort of follows on from that, is active assets. The assets that you're going to transfer over as part of the rollover need to be used within the business. Ultimate economic ownership, same people that ran the business before have to be the ultimate owners afterwards, and you look to who the individuals are. And that's just part of the overall flavour of the rollovers, that if Joe Blow owns his business immediately beforehand, Joe Blow needs to own the business through whatever structure directly afterwards. Again, the others are pretty straightforward. You need to be Australian residents. Everyone needs to choose a rollover, and no super funds and no exempt entities. A couple of things to note: these changes don't affect other taxes. They only apply for income tax. So GST is still a live issue. So if you're going to pay something, which you might choose to do when you're doing these transfers, so you don't get hit with those uncommercial transactions for insolvency type issues, there's going to be a GST issue, and you're going to need to see if you get a going concern exemption, and the Commissioner's got some views on that. If you're transferring it for no consideration, There is a provision in there which says transfers, for GST purposes, if you've got transfers or supplies between associates for no consideration, there is a market value uplift in certain circumstances, so just be aware of that. Stamp duty, particularly for Queensland, where I think we're the last eastern coast state to still have stamp duty on business transfers. Stamp duty is going to be a cost, so you need to weigh up what your other tax savings might be from an income tax perspective and compare that to what you're going to pay in duty for the transfers. Land tax, the only reason I raised that is that for individuals you have a threshold of $600,000 before you have to start paying land tax. If you move to a company or a trust or you're an absentee, that drops down to $350. Payroll tax, I make a note of that just to say that if you're going from one entity with employees to a couple of entities, with employees split, you're still probably going to be grouped for payroll tax purposes. So that's just another additional administrative burden you have to play with. Div 7A is not going to get rid of any old Div 7A loans you have if you're trying to get out of a company structure or company still owes loans, or there's still shareholder loans or associate shareholder loans to the company. This isn't going to get rid of that. And even if you do everything right and you comply with everything, the Commissioner reserves the right to apply Part 4A if he so chooses. And for everyone, Part 4A is the general anti-avoidance provisions. So, case study 1, and I think this is where these new provisions work really well. You've got John, he's young, he started a greengrocer business and it's doing quite well, and he wants some asset protection. He doesn't want to be liable if some of his fresh fruit end up carrying salmonella or something like that. So he's got a couple of options. He can move it to a family trust or a trading company. If we run through those qualifying criteria, he should meet most of those. He's the same economic owner. Whether he's going to a family trust or a trading company, all the assets that are coming over will be active assets. So it's pretty straightforward. I should note for family trusts, if you're moving to a family trust, you need to make a family trust election, and the ultimate economic owners before the transaction need to be within the same family group after that transaction by reference to that family trust election, and you test individual. What I would do is I'll throw this one out to the audience. Here we've got not an uncommon type trading business and separation of the asset holding business. We've got John, but again, he's now 60. He's got a greengrocer business through a trading company. John and his wife Jane have a unit trust which owns the store, which is then leased to the trading company. And they've got an old company which they used as an investment vehicle, and now it just sits there with a term deposit and some ASX listed shares. They want to simplify all of that and get it all into their own name because they're sick of having to make trust distributions, having to do all of the ASIC registrations and effectively 3 separate returns. So I'll throw it out. What do we think about John with his trading business moving it into being owned by John and Jane 50-50? So John owns 100% of the business. After the transfer, he only owns 50%. It's not the same ultimate economic ownership. So that type of transfer is not going to get covered by these new provisions, and if you wanted to do something like that, you'd have to look at if there were any other rollovers or if you could get some of the small business concessions to soften the income tax blow. What do you reckon about the store? The store is owned 50-50 John and Jane through the unit trust, and it's used by a related entity, the trading company, for the greengrocer. What do we think? Again, that should probably get this rollover. Ultimate economic ownership stays the same, should be active assets, and the unit trust, all things being considered, should be a connected entity of the trading company, and the store was used in the trading company's business. What is probably more telling here is you need to have a good, genuine reason for doing it, and restructuring to make your life easier, particularly if you're looking to retire, can be a genuine reason for reorganising your affairs. Final one for the company, $2 million on a term deposit, ASX listed shares. What do we think?
Retained revenue.
Sorry?
Depends on the retained revenue.
The problem with this one is that the cash assets, the $2 million and the shares, have never been used in a business. So they're just sort of sitting off to the side there from something that happened years ago, and we're just playing with the sale proceeds of, say, a business or an investment property that was once in that company. So the issue there is they probably couldn't move it up into their own names, notwithstanding the ultimate economic ownership stays the same, because they're probably, being a company under a unit trust, that cash and those ASX shares, firstly, it's not going to be a small business because it's not really carrying on a business unless it's a share trader. And I think the ATO has put out some views that, you know, if you've got a company and magically you're going to say, I'm a share trader now that you've got this restructure provision, they're not going to buy it. The second issue is they're not active assets because they haven't been used in the trading business. They're off to the side, they're quarantined from a lot of the risk, so you're probably not going to get that either. So that's sort of a demonstration of these provisions, they work really well if you've got this relatively simple structure and you're moving to a simple structure. They can be a little bit more difficult if you've got, I wouldn't necessarily say this is a complicated structure, but when you start to get a bit of separation. And the final case study is a nice simple one. We've got a trading company. For various reasons, John wants to get a new holding company between the trading company and himself. It might be so that you can do some asset restructuring or create a consolidated tax group and do some fun things down the track. But what do we think about that one? So this is a bit of a funny one. The main issue there is that there are some strict definitions of what's an active asset when you're dealing with a connected entity or an affiliate for these small business rollover reliefs. And this is actually taken from an ATO example. What the ATO example says is that the shares owned by John are not going to be active assets because they were never used in the business or in the trading business. And John himself isn't a small business entity. So the consequence is you fall over on the active asset test and you don't get the small business rollover relief for this type of situation. I always like that quote because it makes me feel better when I'm sort of 10 o'clock at night, nose deep in the income tax legislation. But I think that if you're going to take anything away from this, it's that a lot of your small business entities, this is going to be some very useful and some very powerful provisions to give them some nice flexibility to move out of current structures when the timing's available. I should also note that there is current legislation before the Senate. I think most people know they were moving the small business entity annual turnover test from 2 million to 10 million. Nick Xenophon had a death in the family, so debate has been suspended for today. So we'll wait to see how that goes. It's also part of the government's broader enterprise tax plan with obviously the cuts to company tax. So with all the hubbub in the Senate, it might not actually happen. So that's just something to be aware of for now. But yeah, take anything. These are good for those small businesses that want to get some flexibility and some asset protection going forward, or if you've got a relatively simple business that just want to wind up and run out. Any questions?
What's the case study too? Maybe just get some clarification on the tax liability, if they have any at all.
Sure. So the question was, what's the tax liability for this scenario if they didn't get their small business rollover relief? Assuming we've got no access to 15-year rules or anything along those lines, the starting point would be the greengrocer business would, because you wouldn't get the rollover, it would likely just be an A1 event, which is just your standard disposal of an asset. It would be all the assets of the business, goodwill, blah, blah, blah. And you have to get some valuations and separate the difference between the cost base and the capital proceeds, or deemed capital proceeds in these situations. You'd have to pay some tax on it, probably going to be the company being the one disposing of the asset. In terms of the store, you should be right because you get the small business rollover. I should also say in terms of disposing of the greengrocer business, You're likely to hit some stamp duty if it's a Queensland business. You're also likely to hit some GST if you don't document it properly, and if you inappropriately apply the small business rollover reliefs, there's every chance that you might not have documented it properly for GST purposes. We've got stamp duty, GST, income tax. For the company, in terms of the store, should be fine. You should be able to get the rollover. So no immediate income tax consequences. For the $2 million in the ASX shares, they're likely to just be a Div 7A dividend, unless it's done as a loan and documented properly. And if they haven't otherwise paid it as a dividend, you might lose some franking credits, but it's one of those fun ones where you apply what you think is the rule, and then if you try to go back and unwind that scenario and re-engineer what happens, it's always a little bit difficult, and you just have to run through it and find what you think is the most suitable the most suitable situation is in the circumstances, and what the ATO is going to accept if this came up in an audit, for example. No more questions. I'll hand it over.